Has a bear cycle taken hold? Hi, everyone. I'm Maggie Lake, and today I'm talking markets with Katie Stockton, founder and managing partner at Fairlead Strategies and PM of the TACK ETF. Hey, Katie, great to have you back on.
Hi, Maggie. Good to be back with you.
So U.S. stocks and bonds ended the day little changed, a little bit surprising how muted it was after the Fed held rates steady and signaled it would continue to take a wait and see approach. Some people thought we were going to see more of an outsized move, but to be fair, investors have a lot of other things on their plate, including the war and all that's going on between Iran and Israel and whether it'll spread and tweets coming out from Donald Trump as always. So there is a lot to pay attention to, but were you surprised by the reaction?
You know, I thought there'd be a bit more of a volatile knee-jerk type of reaction without any sense of which way it would come, whether to the upside or the downside. So we usually see volatility on the back of the announcement, and usually there's just sort of a churn up into that point. But we do have a holiday tomorrow, the Juneteenth holiday, which is a holiday on which the market is closed. So in a way, it seems like investors might be treating it like approaching a weekend, and a weekend that, of course, could hold a lot of volatility geopolitically. So I don't blame people for not wanting to carry risk these days, and that's sort of our mindset. We feel risk is to the downside right now, short term and even long term, potentially, depending on what your time frame or your definition of that is. So we're managing risk or recommending that our clients manage risk. And I think it's appropriate. I mean, we've seen a massive run up for the S&P 500.
Yeah. We're going to dig into that because Madashir said right at the start, can you ask Katie what her outlook is for risk assets year end? So thank you for the time frame there. And hello to everybody who's joining us live on YouTube and on Substack. Be sure to drop your questions if you have any in the chats, and we'll try to get to as many as we can, as always. So even though MH was asking about risk assets, let's start with the S&P 500, and then we'll work our way around. So it sounds like you're concerned about the downside. Would that apply for the S&P 500? What are you seeing?
Yeah, we are. And you can see it in the daily chart that we posted in our weekly report published this morning. And it's just been not a full round trip, but pretty close to that of the downdraft that we saw into the April low. And now, following that relief rally, we have what we call our signs of short-term upside exhaustion. We use the DeMark indicators, as you know, and they're a great way to gauge that trend exhaustion. And then if you combine them with the momentum gauges and overbought, oversold metrics like the stochastics that you see in the middle window there, those are very helpful, and they tell us when things are a little bit overdone. So if you look at this downturn, we have, sort of enhancing the DeMark sell signal that we had recently. This is all occurring below final resistance, which we're putting around 61.30 for the S&P 500. We are looking for a return to the 200-day moving average, which is initial support on the chart. It's not terribly far below. It was around 58.10 this morning. And we think it would be hopeful to suggest that that's the end point for a pullback. And the reason for that is not so much on this daily chart that you see, but rather on the monthly chart. If we pull up a monthly SPX chart, which I can do here, you can see that we have a loss of long-term upside momentum that's pretty meaningful. So for the past 3 months or so, we've had a MACD sell signal on the monthly chart. And we feel that this is our context, right? This is the context in which we're operating, is with this loss of momentum that you can best see here on the monthly MACD. It follows also some signs of upside exhaustion based on the longer term DeMark indicators. So we're looking for this to be more of like a cyclical sideways or down move within this broader secular uptrend, which you can see in the shaded area being the cloud model that we use, or even just very simply in the trend line that you see there. So operating in a higher risk type of context from a long-term momentum perspective, and then you pile on top of that the loss of short-term momentum that we highlighted in our daily or our weekly research. And we do think risk is elevated.
So when you say that, and based on what you're looking, I want to kind of contrast that to some of the maybe more macro narratives I'm hearing. And I think the people who are worried, and there are quite a few, talk about, okay, maybe we'll see a melt up in the summer, but boy, we have trouble coming, a couple months out, 3 months out. Does that sort of jive with what you're seeing on your charts? Or are you just concerned when you're talking about an elevated risk environment? Are you just concerned about the short-term outlook here?
I think it's sort of both short term and longer term for us, because if you look at both the daily and the monthly chart, we have that same loss of momentum shared by both time frames.
Mm.
And we can liken it probably most closely to sort of a third or fourth inning of 2022 as a bear market cycle. And we did see a bottom around October of 22. So we feel like we could be in store for a similar playbook, but with a bit more volatility on a short-term basis. We've already certainly seen that.
Mm.
A melt up is possible always. I don't think it's a requirement to get that kind of big retracement that we're anticipating. We do have what I would consider to be almost like a stop loss on the upside, and it's where the sell signals that we have are kind of stopped out or negated. And then if that happens, of course, we do have the potential for like a little bit of a short-term up move that can become kind of violent.
Mm.
So for us, that is actually an open by the S&P 500 above 60.79. So it's nice to have this very concrete number, and it's derived from the DeMark indicators. So for those that are short-term, that would be a qualifier above which the sell signals that we have are likely negated, depending on when it happens. So there's some nuances to it, but above 60.79 on an opening print is something that we would feel like, okay, we're being a little bit too bearish short term.
Mm. I know when you're talking about DeMarks, it's music to Tommy Thornton's ears, and he's in the chat and says hello. So
Hi, Tommy.
welcome, Tommy. It's always good when you're with us. What do you make about, so some people have been, having this back and forth that, oh, we've got this concern, there's all this trouble building, and forget about the geopolitical tensions that are kind of roiling markets now, concerns about the budget bill going through, concerns about bond yields, the deficit again. I mean, you name it, we've got tariffs, the impact. Are we finally going to start to see those come through? And yet every time anyone voices all those concerns, stocks have been incredibly resilient. So what are we looking at on the downside? I mean, does it still look, even though the risk is elevated, does this still look like a market that has plenty of people willing to buy the dip? Or is your sense technically that things are starting to deteriorate under the hood?
I agree, Maggie. I mean, it's been remarkable how resilient it has been. And you can just look at the mega caps as a great example of that. In the morning, they're often bid up. And bid up despite what the news is. It can be what you would perceive as negative news, and yet there still seems to be this underlying bid. We feel the mega caps are still very essential to market sentiment, and especially NVIDIA. In fact, I'll show you a chart that we put in the same weekly report, or two charts of NVIDIA, both the daily and the weekly charts. I'll make this a little bit bigger. Hopefully you can see this. And on these daily charts, the daily and the weekly charts, you'll see some more of these sell signals. And what they tell us is that the up move has gotten to a place just recently that it's overdone potentially and due for a good retracement. And my sense is it's going to require a little bit of a crack in this momentum behind the likes of NVIDIA. Microsoft would also be even probably more pronounced in its momentum of late. But you can see that even though they have maintained sort of their momentum on the surface, sort of behind the scenes, when you look at the MACDs and some of these indicators, there is a loss of momentum that is being measured, right? You combine that with also a loss of breadth that is likely after we just saw the percentage of stocks above their 50-day moving averages reach 80%, which is an overbought threshold. Saw that basically at the same time, the volatility index, or VIX, came off of support around 17. 17, by the way, on the VIX is another threshold that we're using. So below 17, maybe a couple of closes below, would be something that would actually be market bullish short term. So that's in a way kind of a stop loss for us if we are having a short position on. So we are still watching that. But the market internal measures would suggest that these moves can really turn on a dime. And we did see that, by the way, back at the February high. It was not very forgiving. It was within a matter of days that we saw the likes of NVIDIA pivot lower, and all the indicators just continued to worsen. So we've seen them deteriorate, and with just a few days of downside or consolidation, they will worsen. So we're definitely concerned, watching the mega caps very closely. Today we did downgrade the technology sector to underweight with a short-term perspective versus the S&P 500. And that's because if you were to take, maybe triple Qs or XLK, kind of tech-heavy benchmark, and you look at it as a ratio against the S&P, you'll see these same types of counter trend indications, and that would be supportive of a retracement. So I do think it would be significant too, because the indications are not just on the daily charts, they're now popping up on the weekly charts. Some of them are ready for sell signals next week, including the S&P 500 in absolute terms. So we're starting to see those same signs of exhaustion kind of carry over to our weekly gauges, which I would take issue with. So we do think risk is heightened. It's largely about the mega caps, as often it is. But I would also take a look at Europe. Have you noticed there, Maggie, that the pullback has already started there?
Interesting.
And so they had really the same setup, the European benchmarks, looking especially at the stock 600, as we do now in the S&P 500. But the last few days have been pretty terrible for European equities, and maybe they're closer to the Middle East, which is something that maybe they're being penalized for. But you can't help but feel like it's going to carry over to the U.S.
Yeah, it's so interesting that you say that. Those of you who had a chance, we had Doomberg was on Monday, and in the midst of a really wide-ranging conversation, one of the things that he pointed out, and he's said this before, but he thinks Europe is the big loser, one of the big losers from the situation, regardless of how it plays out, because it brings that fundamental issue of their lack of secure energy back to the forefront. And when momentum was driving this, people were willing to overlook it when the rest of the world trade was on, but that's always been in the backdrop for people who were concerned. And so now does that come back to the surface after some really good gains and start to chip away at some of the bullishness around Europe? That was a really interesting comment. So you can catch that, of course, that full conversation.
Yeah, no, I totally agree. And I mean, the DAX has been just on a tear, especially if you zoom out to the long-term charts of the DAX. It's still a very strong uptrend, but boy, the retracements can be pretty severe when it steepens as much as it has done.
Yeah. And another thing on that, another point on that, in another conversation, remember Operation Spiderweb really, for some people, changed a lot about what they're thinking about in terms of defense and even the nature of war. And some of the bigger gainers in Europe were big legacy defense companies. And I've been asking geopolitical analysts, is that what this looks like? Is that the future? And some really, really big questions raised. So that's another interesting angle for you to, if you are holding any of those stocks, you're exposed to Europe, for you to maybe take a step back, and in conjunction with some of the technicals Katie's talking about, you might want to look at some of those fundamental narratives. That conversation was with Jacob and D. Smith, by the way. But it's interesting, right? It's always a sort of multitude of things that you've got to kind of take into consideration when you're looking at some of these sectors. So J&J was asking, what do you think about the sectors? You talked to us about information technology. What else are you, are you looking at in terms of who might perform well in this environment, and where would you be looking maybe to reduce exposure? And I'll just lay on that for everyone who was listening to the Fed and what they had to say. In addition to holding rates steady and saying they're in wait and see mode, looking about the impact of tariffs, they also lowered their growth forecast and raised their inflation forecast for next year. So that kind of stagflationary, warnings coming from the Fed. So what sectors are you looking at? And give us that time frame.
Yeah, so I'm trying to open up I want to show you where TACK is positioned, because it's obviously aligned with where we feel there's long-term opportunity for relative performance on the sector front. And yet we also zoom in on the shorter time frames in our research. So if you can see this, hopefully, we are pretty defensively positioned. You can see, as an example, consumer staples, real estate, and utilities are components of the TACK ETF. But importantly, also notice that these are risk-off ETFs. So this would be short-term treasuries, gold, and long-term treasuries, which amount to about 25% of our exposure. So as much as we're defensive leaning in our sector exposure, we have this big slice of the pie designated for these so-called risk-off categories. Because what tends to happen, we all know that most of the sectors will certainly not underperform, but participate on the downside, in a weaker tape. So we're not just living in this relative world, right, where we're looking for relative performance. We actually want to see these things post gains on our behalf. In our research, you can see we have recommendations that are more short to intermediate term in nature, and we're moving to an underweight just today on consumer discretionary alongside technology. So that's because we've seen a loss of short-term momentum there. That would suggest that it probably ultimately gets kicked out of the TACK ETF as well if it carries over to the longer-term metrics. We're equal weight quite a few of the sectors. Where we're overweight would be consumer staples. It looks a little counterintuitive. This is the ratio against the S&P 500, but this ratio now has oversold indications here that are somewhat compelling. And energy would be also somewhat counterintuitive, but it's a counter trend move that has decent momentum for obvious reasons. So if you're willing to take a short-term position, I think you can leverage this relative performance from the energy sector here. We highlighted a chart of natural gas too, which is starting to appear to sort of resume its uptrend. The final overweight that we have right now is utilities, and much like the consumer staples ratio, it also has signs of downside exhaustion after undergoing what we think is a longer term turnaround for utilities. So we have a lot of ways that we're looking at the sectors, and I do feel like defensive positioning is appropriate here short term, and probably also for the balance of the year. When we see markets go down, these are the sectors that are relatively insulated typically. And I could expand that even further, that strategies that are more conservative, like, equal weight strategies, or, where you get more diversification away from tech especially, and dividend appreciation types of strategies or hedged equity strategies. Those have underperformed of late, but they should kick in as sources of outperformance in a broader portfolio.
This is an interesting question. Paul asking, Katie, you've been consistent in your calls for a pullback for a month now. When do you anticipate that the markets will catch up with the MACD and DMARC indicators?
Yeah, so we shifted to a bearish short-term bias on May 28th. So it has indeed been I'd say, an exercise in patience, waiting for the so-called pullback to unfold. So that was like right around here. And we think it's just a matter of days before it does. We're not giving up on that sort of bearish view. And I say that because indicators still point that direction. So even with the firmness that we've seen, largely contributed by those mega caps, I think that, as long as the indicators are still supportive, we're going to stick to that. Especially keeping in mind the longer term metrics as well. But we do have that so-called stop loss on the bearish view, where we give up on it. There is an actual number at which that happens, and it wouldn't for us require breakout to new highs, but rather an open above that 60.79 threshold, because that would be enough evidence that the momentum is just strong enough to shrug off all of the signals that we do have. It's pretty rare for a MACD to turn as early as this did, which was in May. But if you look at it, certainly if we look external to the S&P 500, to anything that has, lesser exposure to the mega caps, a lot of things really have made very limited upside progress since mid-May even. So the real push higher came, in April, and then sort of extended in early May. But there has been a global loss of momentum really since mid-May on a short-term basis.
So I want to just jump to another area that I know you're watching and a lot of people are watching, and that's the dollar. We've seen the dollar fall against the euro, the pound, the Swiss franc. I think I saw a line today down 10% against those currencies. Sometimes with this, it's what kind of cycle are we in? Sometimes it's the speed with which things decline as well. What are you looking at for the US dollar? This seems incredibly important, but it's easy to forget on a kind of day-to-day basis.
Yeah, without question, we are watching it. And the dollar index is what we're using as our proxy typically. It has taken out an important Fibonacci retracement level. And the Fibonacci levels we find to be very relevant for commodities and FX. So if I can show you the chart here, you'll see that it has what we call a breakdown pending confirmation. So the breakdown would be confirmed actually this Friday if we see the dollar index close below 99. So it's actually a little tenuous because it's pretty close to 99 right now. If we don't see a breakdown, all that would mean is that we're due for a bounce probably before a breakdown. But if we do confirm a breakdown, the next support for the dollar is actually pretty substantially below, and it's not even a major level. We have it at 95.2, which would be a pretty big move. I mean, we've already seen a big cyclical down move, but it would be something that would suggest that it extends itself pretty meaningfully. And we do have, I would say on the flip side, a very long-term breakout that we've seen in the euro. We also like to apply our cloud model to FX, and it cleared the monthly cloud at the same time the dollar index broke the monthly cloud. So we're assuming that the cyclical downtrend will generally keep hold for much of this year, if not longer, just based on the breakdowns that we've already seen, and especially if this current breakdown is confirmed.
So this is this sounds like, does speed matter here? I mean, I know sometimes when this is what you worry about. Is this a rapid decline, or does it have the potential to be, or is this kind of just a slow grind kind of dollar bear market?
Yeah, I feel like it was pretty rapid in the earlier stages, and that's often the case. So I wonder if it doesn't get into maybe a little bit lesser of a slope on the downside. That's not abnormal. You can see it also in the momentum gauges. So as it has come down, even though the weekly MACD still points lower, the histogram, which is kind of like almost that speed that you refer to, has ticked up, and it continues to tick up, meaning it's still downside momentum, but it's less than it was before. So I would say it would make sense to perhaps see it become more of a grind lower as opposed to a sharp decline. But boy, we've already seen that, right? It's down from about 110 on the dollar index, which is pretty remarkable.
Yeah, it is. And I asked because for all of those of you know that there's a lot of comments about, so many sovereign wealth funds and big insurance companies abroad hold so much US assets. And if the currency starts moving really rapidly, if they are unhedged, what kind of losses do they have? Does that create problems? That's why I was sort of, asking about the speed. That's where things get really tricky. A different Paul asking, how about gold and silver? Was that mentioned yet? I think you were bullish gold, right?
Yeah, but let's go ahead and talk about it. I'll show my gold chart from this morning's note. It's a long-term uptrend. So we've been constructive on gold for a long time, and we were calling for consolidation because we did have signs of upside exhaustion from those same DeMark indicators. But this short-term breakout that you have would suggest that it can even reach new highs. So we're expecting an improved sort of momentum setup for gold. What's been more interesting, frankly, is platinum and silver, both of which have pretty major breakouts. We even noted today in our morning note soybeans and bean oil. I'm not saying that that's something we're really trafficking in much, but there's always something out there that's working. And, there are some commodities that just have a much better shape to them at present versus some of the equity market benchmarks. So gold, we're just assuming will sort of maintain its long-term uptrend. And to the extent that we can find these catalysts to act upon, then I think it's worthwhile. But at a very minimum, might have some, sort of slice of your own portfolio in gold right now.
Yeah. It's funny that you brought up soybeans. Do y'all remember who brought that up recently? Miss Schneider, commodity queen. Yeah, she was pointing that out, and we were like, soybeans? Who's mentioned soybeans lately? As usual, she's got such a good pulse on that, and is such a good sort of market watcher when it comes to that. We'll have to follow up with her on that. We haven't mentioned treasuries, which is another terribly important thing. We've seen those yields really kind of stuck. It looks like in a range. After, again, some volatility, it looked like, bond vigilantes were coming back. Maybe it's just because the spending bill is grinding its way through Congress and frankly has been overshadowed by what we're seeing on the geopolitical front, from headlines that can drive this. But what are you looking at for treasuries?
So
you mentioned that you have exposure to the long end in your ETF, right?
Yeah, we do. And we're actually pretty comfortable with that because along the same lines of these more conservative investment strategies on the equity front as likely to outperform in the near term, we have those same signs of downside exhaustion for long-term treasury proxies to suggest that they will start to outperform equities again. You'd imagine that that's probably not a great comment on the direction of equities. On the long-term setup for 10-year treasury yields, I think it's fascinating. I mean, it's just a proper trading range. You can see it. The trading range is bound by about 474 and about 38 on the downside. Within that context, I would say we have indications that ultimately we're going to see an advance from this range. So we have a little upturn here and a lesser downside momentum here, but I don't think it's in any rush. We have just a consolidation phase that's kept hold for more than a few weeks, very much tethered to, I'd say it's about the 4.4 level. And it's funny, like even today, folks are looking for some directional takeaway. I say, no, well, your yields are higher because of this. Well, I would argue that yields, really it's all noise. We've seen just a bunch of noise of late in yields as this tug of war has been going on, and it's representative of an uncertain period, right? And sort of fickle action in treasuries, and not until we actually can clear some significant levels in yields will we really kind of assert a directional bias here. But just for the yield and for the potential for treasuries to outperform equities as they pull back, we're comfortable having some exposure.
J&J asking, I don't know if you're watching this. I love I love the folks in this community. They're really down deep in these markets. Would love Katie's view on Palladium if she has one. It's been underperforming platinum so much recently.
Palladium. Okay, so let's try to pull this up. XPD. No, wait a second. Why don't we try to find like an ETF for that? Because there's an ETF for everything, isn't there, right?
Yes, these days, which we like to remind people because there was a time when there were no such thing as ETFs. I mean, this is like we talked, by the way, somebody was getting smoked, shorting Circle in the chat today. I can imagine because they did, I think legislation passed on stable coins. So watch this space. But all of this financial innovation is coming. So pretty soon I have a feeling we'll be like referring to things like they've always been around, just like ETFs. But yes, there's an ETF for everything.
It is opportunity, right? It's opportunity to invest in areas that otherwise might not have been as accessible. So I love that. And we found one here, PALL. So it's not something we talk about often. This is the monthly chart. You can see a basing phase, or what appears to be one. So usually the difference between just a trading range and a basing phase in my work would be one that follows a downtrend and then has this improved momentum. So you see the momentum improvement. You see also this compelling upturn in our stochastics after a nearly oversold test. So I'd say that long term is really very, very interesting. Feels like an early stage turnaround. And then it's just a matter of looking for, short-term catalysts, right, to add exposure into. And usually for us, that means a breakout or some kind of, MACD buy signal or something like this. So the cloud model also, being something that we adhere to quite a bit, shows resistance basically in line. This is on the weekly Palladium ETF chart. So with just a little upside follow through, we'll have a breakout that we would say is significant for this PALL ETF. The level to watch is 95.72 on the cloud. So a couple weekly closes above that becomes a nice longer term breakout. So we're always looking for catalysts, especially in sort of more volatile tapes, but the long term is very promising.
Amazing. On the fly. You just
this is what we do.
This is what you do. Should we wrap up on oil? Because I don't think we've mentioned that. I think you touched on energy, but it's tricky, especially if you're trying to think about this in the context of these really quick moving geopolitical headlines. And this is where I think the work you do is so, so important and interesting because, what else are we seeing? And is that backed up by what you're seeing on the chart. So yeah. And Andrea saying, do you believe the new war is priced in?
Yeah, I
Andrea,
would
you
say,
and I were having the same mind thought. Yeah. So what are you
yeah, in
looking at?
terms of crude oil, yeah, you never know, of course, but we don't have any sell signals yet, right? So if you look at crude oil, the relief rally, which was supported by the indicators, but not of this magnitude, right? So it was already like sort of primed for a bigger relief rally. But it is pretty impactful because even just like that Palladium chart, you see that crude oil on the weekly is testing some of that similar resistance. It's around 76.5. Above that, we're watching a Fibonacci level around 84. So, if it can break out, which the indicators would generally suggest it can, we would expect an extension higher. But we're still viewing it as sort of a counter trend setup and situation, and obviously one that's subject to pretty significant, headline risk, if you will. So we're not necessarily owning it here. We're maybe trading it here. And especially with natural gas having lined up somewhat positively after looking sort of toppy to me, it's kind of come out of its consolidation to the upside. So I think that if you can find, maybe it's a proxy like an energy sector diversified ETF, like an OIH or something, as a way to position to take advantage of it, you'll have diversification built into that. And, it doesn't maintain the same positive correlation to the S&P 500. It can have a mind of its own. We saw that in 2022, where it can go higher when most everything is sort of flat or going lower. So I think there's a trade here. If interested, I don't think it's necessarily priced in based on the lack of sell signals.
Amazing stuff. Katie, always such a pleasure to catch up with you and get a little peek into all the great work you're doing. Fantastic stuff.
Of
yes,
course.
Paul said Katie rocks.
I see it now. I found the chat box.
But really fantastic stuff. And again, we say this because there are so many headlines moving things. It's really nice to have other things in your toolbox to look at. And this is such an important area, and Katie's one of the best at it. So
I appreciate it. Yeah, take a little emotions out of it, right?
yes, and get some validation if what we're thinking is true. So just a heads up, everyone. Some housekeeping. Friday, so it's a holiday, market holiday, if you're not aware, in the US, a relatively newish one. Markets are closed tomorrow, and of course we're heading into summer weekend, so we will be doing the show Talking Markets live, but at 11:30, and we're going to have JJ Alyosha on, who's amazing and also a really experienced trader. So if you want to join us for that, tune in live at 11:30. Otherwise, you can watch it on replay on both YouTube and Substack. And for people just joining on Substack Live, if you missed the beginning of Katie's, you can watch it there. And we'll also do a write-up, as we always do, with the video attached, so you can catch up on all her great advice there. So thanks so much for everybody for joining. And Katie, thank you so much. Have a wonderful long weekend if you get to take Friday off. I don't know.
Maggie. Thanks,
at least the sun's coming out where we both are after 2 months of rain. And so we're super excited.
We deserve it.
We do deserve it. Thanks, everybody. As always, take care and good luck out there.